It's Monday, 13th of July, 2026. Welcome back to your news update on Blip Brief, crisp, but almost everything updated every market trading day. So, looking at the previous trading day's close, the bulls were just in absolute control. Both the BSE Sensex and Nifty 50 closed up over 1%.
Yeah, but the real story, the one that actually had trading floors buzzing on Friday afternoon, was that massive mid-cap action.
Oh, absolutely. Goldium International surged nearly 20%.
Huh?
Ion Exchange and Godrej Industries both jumped over 16%.
Right, and on the losing end, you had Master Trust and Dealing falling over 7%, plus precious metals slipped just a bit to end the week.
Yeah, gold was down roughly 0.7% and silver dropped over 1.3%. So, what actually drove that massive index movement?
Well, it was fueled by upbeat global cues, sure,
Eh,
but locally, it was a highly calculated market cap surge led by the heavyweights in banking and telecom.
We're talking HDFC Bank and Airtel, right?
Exactly. They were the engines pulling the indices higher. Let's break down the mechanics here. When you have institutional investors pouring massive capital into the absolute largest companies in the index, their heavy weighting mechanically pulls the entire market average up.
It creates this irresistible halo effect.
Yeah, retail investors see the green on the board, confidence surges,
Mm-hmm.
and that capital enthusiasm clearly just spilled over into that massive mid-cap rally you mentioned.
Right, but let's unpack this, because today we are looking at how global chaos, from missiles in the Gulf to the AI revolution, is forcing Indian institutions to completely rewire their survival strategies.
It is a totally different landscape today.
It really is, and this is exactly where Friday's optimism collides with Monday's reality, because the previous close looks great, but driving based on Friday's numbers feels like, driving a sports car while looking exclusively in the rearview mirror.
That is a very dangerous way to drive.
Exactly. Aren't pre-market indicators telling us we're about to hit a massive geopolitical pothole today?
Oh yeah, that is exactly the harsh reality check we were waking up to. The Gift Nifty, which basically acts as our early warning system, is flashing deep negative signals for today's start.
So that Friday optimism is just evaporating.
Rapidly. The catalyst is a severe weekend escalation between the U.S. and Iran. We are looking at verified reports of heavy missile and drone assaults across the Gulf.
And this isn't just, diplomatic posturing or saber rattling at the UN.
No, it's his kinetic, destructive military action in literally one of the most economically sensitive regions on the planet.
And it hits the absolute worst choke point imaginable, right?
Sure.
Iran claims it has essentially closed the vital Strait of Hormuz.
Right.
For those tracking the geography, that single narrow waterway is the bottleneck for a massive portion of the world's daily oil supply.
Yeah, if it closes, the plumbing of the global economy backs up.
So the immediate fallout we're seeing this morning is global shipping lines halting fresh cargo bookings. They simply cannot and will not risk their multi-million-dollar vessels.
Which is precisely what triggered the violent reaction in the energy markets. Because of that supply chain panic, Brent crude futures jumped roughly 3% almost instantly over the weekend.
But the timing here is just, it's wild. Just days ago, Saudi Arabia had slashed its Arab Light crude prices for Asian customers by a huge margin.
A massive margin. It was a highly strategic, offensive play to lock in Asian buyers.
They were trying to stimulate demand and protect their market share against cheaper alternatives, right?
Exactly. And Asian importers were expecting significant economic relief from that Saudi discount. But this sudden geopolitical flare-up in the Gulf has instantly spiked the global baseline price again?
So it completely wiped out the discount before a single barrel even reached a port.
Exactly. The relief vanished instantly.
So what does this all mean for the Indian economy? We have to connect this global macro shock directly to you, the listener. A 3% jump in crude oil immediately translates to imported inflation.
Absolutely.
Yeah.
It burns your pockets directly at the petrol pump, yes, but it also increases freight costs for literally every single good transported across the country.
Right, your groceries, your electronics, your clothing, the logistics premium just went up.
And this shock is hitting at a highly vulnerable moment for our domestic economy. June retail inflation is already projected to have climbed over 4%.
Which, let's be clear, officially breaches the Reserve Bank of India's targeted comfort zone.
Yes. So when you breach the target zone before an energy shock even hits the data, rising energy costs will only pour gasoline on this inflation fire.
So any hopes you might have had for a rate cut to stimulate corporate growth?
Effectively off the table. It puts the central bank in a highly defensive, cornered position regarding interest rates.
And if the central bank is cornered on inflation, their currency headache is even worse. Global headwinds are fully expected to cap the rupee's gains through the rest of the year. And to defend the currency without triggering a full-blown market panic, the Reserve Bank of India is stealthily unwinding a massive multi-billion-dollar bearish short forward position.
Yeah, it is a critical maneuver to understand. A short forward position essentially means the RBI had previously committed to selling dollars at a specific future date.
And they did that because foreign capital was flooding into India in the past, right?
Exactly. They needed to absorb that excess dollar liquidity to prevent the rupee from appreciating too fast.
Which would hurt our exports.
Right. But now, the macroeconomic winds have completely reversed direction. The RBI needs to quietly square off or unwind those old positions. To do that, they have to go into the market and buy back those dollars.
Let me see if I have this analogy right. It feels like watching a bomb squad defusing a highly sensitive wire in a crowded public square.
That's a good way to look at it.
They need steady foreign capital inflows to provide cover while they unwind this position so they don't accidentally crash the value of the rupee by showing their hand. But wait, if global markets panic over Iran and foreign capital retreats to safe havens like U.S. Treasuries, doesn't the RBI's strategy suddenly become much more dangerous?
Dangerous is an understatement. It becomes precarious. That foreign capital you mentioned is essentially the blast shield the bomb squad is hiding behind.
So if that shield gets pulled away,
the RBI is left holding the wire cutters out in the open. Here's the cascading effect. If they continue actively buying dollars at the exact same time that spooked foreign investors are pulling dollars out of India, it creates a massive vacuum.
The demand for dollars spikes violently, the demand for rupees plummets, and the currency depreciates sharply.
Exactly. The RBI is trying to walk a tightrope in the middle of a geopolitical hurricane right now.
Well, if the central bank is playing a high-stakes game of risk management, corporate boardrooms across India are doing the exact same thing with their cash reserves.
Oh, absolutely.
Let's pivot to how Indian companies are navigating these cross-currents, specifically looking at IT and retail earnings. Despite the macro storm, we are seeing some incredible resilience. DMart, for instance, posted a net profit jump of over 11%.
Which tells you that domestic consumption, at least in the value retail segment, is still holding the line.
People are still buying the essentials.
Yeah, domestic consumption is the anchor keeping the ship steady. But the export-driven services sector is where the massive tectonic structural shifts are happening.
You're talking about Tata Consultancy Services.
Yes. Let's break down their numbers. On the surface, the headline numbers look acceptable. Sequential growth was flat, and year-on-year revenue rose nearly 14%.
Which looks pretty solid to a casual observer.
Right, but the real story isn't the revenue. It is internal. TCS is completely restructuring 14 top leadership roles and creating 5 brand new specialized business units.
That is a massive internal earthquake for a company of that scale. To rip up the organizational chart like that overnight, why the sudden overhaul?
Because they are fighting a war against obsolescence. It is a direct defensive maneuver to combat what industry analysts are calling AI deflation.
Because the traditional Indian IT model for decades was based on headcount and time.
Exactly. You bill an overseas client based on the number of engineers working on a project and the hours it takes them to complete it. But generative AI fundamentally breaks that math.
Right, because an AI assistant allows a single mid-level engineer to do the work of 5 junior engineers in a fraction of the time.
Precisely. If the same coding task takes drastically less time, your billable hours drop off a cliff. That is AI deflation.
So the revenue shrinks not because you lost the client, but because you became too efficient.
Yes, so TCS is aggressively restructuring to secure a multi-billion-dollar AI deal pipeline. They realize they must transition from selling hours to selling outcomes and high-level AI integration.
So they are purposely cannibalizing their old business model before AI completely destroys it for them.
Exactly. That is why they created those 5 new specialized units.
That transition from selling time to selling outcomes is profound. And it brings us to a broader, arguably worrying trend across India Inc. Corporate capital expenditure, the money spent on physical growth, is just stalling.
Right.
Companies are not building new factories or scaling physical operations at the rate the government expected. Instead, they are taking their profits and piling their cash into financial investments. Are Indian businesses essentially hunkering down in the bunker?
The data strongly suggests they are in preservation mode. Think about the mechanics of corporate investment. When you have high inflation, A volatile currency teetering on RBI intervention and a major geopolitical conflict threatening global oil supplies.
Corporate boards become highly risk-averse.
Yeah, capital expenditure requires a predictable future. If you build a factory, you need to guarantee a return on that investment over a 5 or 10-year horizon.
Right, you need to know what your energy costs will be, what the currency will be worth, and what consumer demand will look like in 2030.
Precisely. And right now, there is zero predictability on any of those fronts. So corporate treasurers are making the safest bet available. They're parking cash in financial instruments, earning a safe yield, and just waiting for the storm to pass.
Which is a highly rational survival tactic for an individual company, but if every major corporation does it simultaneously, it severely drags down national economic growth.
Exactly.
Which perfectly explains the Indian government's current aggressive posture. If corporations are too cautious to build the future, the state has realized it has to unilaterally secure the foundation.
Yes, we are seeing massive aggressive moves by the government to secure energy and defense independence, so we aren't held hostage by this Middle East chaos.
Like the clear, accelerated pivot toward nuclear energy, India just secured a major uranium supply agreement with Australia.
And this isn't just about diplomatic ties. It's a mechanical necessity. This uranium is designed to rapidly expand our domestic nuclear power generation.
Which provides baseload power that is completely insulated from Middle East oil shocks.
Exactly. Simultaneously, the state power giant, NTPC, is aggressively hunting for overseas uranium assets.
They aren't just buying fuel, they are trying to buy the mines.
Right. They want to lock in the raw materials for decades of uninterrupted sovereign power.
And while we try to secure our nuclear future, we have to talk about what is happening right now with oil, because it leads to the Russia-petrol paradox.
That is one of the most fascinating twists of global trade I've seen in years.
It really is. Because the ongoing Ukraine war has severely disrupted traditional Russian oil refining capacities, India has surprisingly emerged as a massive supplier of finished petrol back to Russia.
It is a stunning reversal of traditional global energy flows. Historically, Russia is the gas station of the world. They pump the crude and export refined products.
But Ukraine has targeted and damaged a significant portion of Russian refining infrastructure.
Right. So Russia still has millions of barrels of crude oil, but they are struggling to process it into usable petrol for their own economy.
And that's where India's geographic and infrastructural advantage kicks in.
Exactly. India is stepping in to buy that raw Russian crude at a steep geopolitical discount. We then utilize our massive domestic refining capacity.
Facilities in places like Jamnagar.
Right, which are some of the most complex and advanced in the world. We process it, and then we turn around and export the finished high-margin petrol back to Russia to fill the gaps left by war damage.
It is a highly lucrative arbitrage play for Indian refiners. They are capturing massive margins simply by capitalizing on global instability and infrastructure bottlenecks.
And that same theme of capitalizing on global instability is completely transforming the Indian defense sector. Because it's not just energy independence. Military independence is becoming a hot ticket for foreign capital.
This raises a critical point about the privatization and globalization of India's military-industrial complex. We just saw the news that the Carlyle Consortium is taking a controlling stake in Micropac.
This is a watershed moment. Micropac isn't just a generic manufacturer. They are a crucial Indian supplier of highly sensitive defense electronics for India's space agency, ISRO, and its premier military research arm, the DRDO.
Having a massive global private equity player like Carlyle take a controlling stake in a foundational defense company, that sends a massive signal to the market.
It signals that foreign capital sees long-term, structural, secular growth in Indian defense manufacturing. These global funds are making a calculated bet that the Indian government will continue to heavily localize its defense supply chain.
To avoid relying on foreign powers.
Right. Carlyle wants to own the foundational electronics companies that will inevitably benefit from those massive locked-in government contracts.
But, the future of defense might not rely on traditional electronics or even traditional ammunition at all. Which brings us to a major technological breakthrough that changes the very physics of warfare.
Yes. The DRDO, India's military research agency, has successfully tested a new, entirely domestic laser weaponry system. We are officially entering the era of directed energy weapons.
Okay, we need to explain this simply because it sounds like something straight out of a science fiction movie. Wait, so if it's an electromagnetic beam, does that mean it's completely silent? I'm imagining a movie scene with bright red lasers making pew-pew sounds, but in reality, how does this actually change the battlefield?
Forget the movies.
Hmm.
The reality is much more terrifying for an adversary. Traditional warfare relies entirely on kinetic projectiles. Think bullets, artillery shells, interceptor missiles.
You have to manufacture a physical object, transport it, load it, fire it, and eventually you run out of them.
Right. Directed energy weapons do not fire physical objects. They use highly concentrated electromagnetic energy. You are firing a beam of intense energy, usually a high-powered laser or microwaves.
So, if an enemy drone swarm is approaching, what does this actually mean in a combat scenario? Does it burn them out of the sky or hack them?
It structurally compromises or fries them. And it matters for three revolutionary reasons that change the entire math of conflict. First, the physics. It operates at the speed of light. You cannot dodge it.
Whoa.
By the time enemy sensors even detect that they are being painted by a laser, the energy has already hit them. It is instantaneous. Second, the logistics. It has a virtually infinite magazine.
As long as the platform, like a naval ship or a mobile army truck, has a functioning power source and generator, it can keep firing.
Exactly. You never have to call for an ammo resupply.
And third has to be the economics, right?
Yeah.
Because defending against cheap drones has become wildly expensive.
Exactly. The cost-to-kill ratio is the real revolution. A traditional kinetic interceptor missile used to shoot down a surveillance drone can cost millions of dollars. The drone itself might only cost $10,000.
That is an unsustainable economic equation for any modern military. You literally bankrupt yourself trying to defend your airspace.
But a directed energy shot. It costs a few dollars in diesel fuel to run the generator to create the electricity. It could theoretically disable enemy drones or melt advanced electronics completely silently, ending future conflicts before traditional kinetic weapons are even drawn.
An infinite magazine operating at the speed of light for a few dollars a shot. It fundamentally changes the economics and physics of defense, which leaves you at a fascinating question to chew on. If the future of warfare relies on continuous electricity rather than stockpiled gunpowder, will the ultimate global superpower of the 21st century be the one with the biggest army or simply the one with the most secure, uninterrupted power grid? Something to think about as India hunts for that Australian uranium. And just before you go, a quick note. This deep dive commentary was put together using advanced AI. We always strive for accuracy, but please do cross-verify any crucial information yourself. Your informed decisions are what matter most. The content shared here is for informational and educational purposes only and should not be treated as investment or trading advice. Past performance is not indicative of future returns. We are not licensed financial advisors.